Today, we're going to talk about startup funding rounds. Understanding how the funding rounds work when you get into raising money is incredibly important. My name is Heine Zachariasen. I'm the founder of Vivino.
The world's most downloaded wine app.
Vivino changed the billion-dollar wine industry. Now I help other builders change the world. I will call things as I see them, no filter. This is Raw Startup. Most startups go through multiple funding rounds. I want to show you guys how the rounds work, what to expect from a round, and what the characteristics are for every single round that you go through. Nothing is really set in stone. Some companies get revenue very, very early and it works out just fine. Others get revenue very, very late and that works out just fine too. I'm going to talk about what the rounds typically look like for a startup. Since a startup goes through multiple rounds, the valuation, everything changes round by round. One thing I can't stress enough is that the money in the early rounds is very, very expensive. So be careful, don't spend too much money in the early stages. It's expensive, you need that equity for later. Here's how an actual funding round works. Every time a round is made, new shares are issued. All the existing shareholders are diluted. Let's have a look at an example. Let's say we have a company that's worth $1 million. Somebody wants to invest $150,000 into this company. The founder has 60% of the company before the investment. Let's see what happens after the investments. The shares are issued and the capital is increased, and after the investment, the founder has 52% of the shares. Getting great investors on board and getting diluted for that is definitely worth it. What you need to be careful with is not giving away too much of the company in the early stages. And all the great investors, they know they can't take too much of the company in every single round. They know that founders need to have a good chunk of the company to keep them motivated. So be careful with not giving away too much in the early stages. You will need it in the future for future rounds. I'll go as far as to say that if the founders have given away more than 50% of the company before an A round, we'll talk about an A round later, the company just becomes uninvestable. There just won't be room for future rounds and the founders. So be careful with giving away too much in the early stages. Another general advice for these rounds is to try and get a new investor in on every single round. The reason for this is that every time a new investor comes on board, they pay a premium to get in, which means that you can usually get a higher price from a new investor. Okay, let's get started. Let's go through the actual rounds here, see what the different funding rounds look like. I'm going to go through them one by one so you can see the typical characteristic of every single round. Okay, so here we have the stages that we're going to look at, all the different funding stages we're going to go through. The first one is the idea stage. What we have now is basically just an idea. Maybe you have a little bit of a PowerPoint, but there's an idea, there's no product, there's no real company. At this point, there are no professional investors. What we have is either self-funded, you find the money yourself, maybe you have some friends and family that are willing to invest. At this stage, again, people don't really invest in the company. The people that do invest, they invest in you because they like you, they love you, whatever. So we call this friends and family territory because that's usually what invests in the idea stage. Professional investors will mostly stay away. For Vivino, that was also the case. We tried to build as much as we could with basically no money and put a little bit of our own money into it to make it happen. The next round is an angel round. So now we're at a point where we're starting to have some sort of product exploration. Maybe we have a proof of concept or something like that. At this stage, they call the angel round because this is when the angels show up. Angels are usually smaller investors that invest their own money, and they're willing to invest at these very, very early stages. I definitely say that the angels you see vary in quality. Some of them are good, some of them are not so good. They usually invest, like I said, their own money. If I was going to look for an investor, I'd usually look locally. I'd look for someone who is in a similar business. Maybe they made some money in a similar business and want to reinvest that. So that's my recommendation. And again, they're not all that professional, so be careful they don't try to grab too much of your company at this stage. You will need that equity later. With Vivino at this stage, we were fortunate. We know a guy called Janus Fries. He's one of the founders of Skype. He knew us, and he was a passionate wine lover, or is a passionate wine lover. We went to him, pitched the idea, and he funded our angel round. So now we're getting into the little bit more professional area. The seed round, you start seeing actual venture capitalists. You'll see both angels and venture capitalists. There are quite a lot of these venture capitalists that specialize in seed rounds. So there is some money out there. From the company point of view, there is probably a proof of concept. There's usually some kind of product. It might be released, it may not really be released. Usually no revenue, or if there is any, very, very little revenue. At Vivino, we had actually released the product at our seed stage. It was a very limited, very, very basic product. It did work somehow. And we were fortunate to find some local venture capitalists in Copenhagen. Again, I still recommend seed stage, usually stay local or in your general area. We ended up taking investment from a company called Seed Capital based in Copenhagen, and that worked out really well for us. Well, the A round, this is the big league. This is where you make the really, really big jump. Very, very few startups actually make it to the A round. Almost all the investors here are professional investors. They see hundreds of startups every single year and invest in very, very few of them. So getting to this stage, getting investment here, that's usually the very, very successful startups. The product's out there. At least there is a proof of concept. Usually you have a pretty decent traction. You have a decent traction too. Vivino was in a position where we started to really get downloads. We hit around 1 million downloads at this point. We're definitely not the clear category winner. So I think what we see typically at the A round stage is that, yeah, there's definitely a proof of concept for the product. The product works. There is a product market fit. And this is probably going to be one of the companies that are going to compete for whatever is in this market. Revenue at this stage, it depends on what kind of product it is. If you're a consumer product, you most likely don't have any revenue. If you're more of a service, B2B, you probably do have some revenue. With regards to the investors, again, they're professional. They might not be in your local area. So in Europe, you might want to go to Berlin or to London or something like that. And over here in the US, some people will go to Silicon Valley, others will go to New York, and so on. You have to go a little bit further usually to find money for an A round. Like I said, Vivino had a pretty decent product when the A round was made. We just hit about 1 million downloads and we're growing pretty fast. We looked around Europe for an investor, and we ended up picking Bulletin Capital out of London and Creandum out of Stockholm. And like for most consumer products, revenue was not a big thing. We had tested some revenue, but there was very, very little revenue at the A stage. So the B round, now we're at a little bit different, because I'd say that it doesn't really matter what type of company you are. Usually when you get to the B round, you either have some revenue or have shown that, yes, there is a proof of revenue here. So we're getting to a point now that this has become a real business and we're ready to scale it. You wouldn't see angels here. You would see venture capitalists. Sometimes you would even see what we call private equity, which is later stage companies that they usually only come in when what we call the cookie cutter has been built. When you have something that can make money, you pour more money into it and you make even more money. They're not typical at a B round private equity, so most of them are venture capitalists at this stage. Vivino went in a little bit of a different direction on this one. We had an industry player. We had the CEO and chairman of Moët Hennessy, who passionately loved Vivino and wanted to invest. So we took an investment from Christophe Navarre, and that was very successful for us to raise the round from an industry player. Not that common, but it worked well for us. When you get to the seed round, usually you would have real proof of revenue. You would not only have proof of revenue, you're also either a winner in the space or one of the players that are going to win this space. So it's very, very mature at this point, and you'll also see more of the investors I talked about earlier, definitely venture capitalists, but also private equity. They can see a direction now that could be an IPO further down the line, so they're getting more and more interested. Vivino, at the C stage, we decided to go with our existing investors. They wanted to put in more money and raise the entire C round from our existing investors. After the C round, you can keep going, and I'm sure you know the alphabet, but they don't change that much in character, but they can keep on going. So some people go very far, some people stop at the C round. It varies quite a bit. The next thing that really changes after that is if you get to an IPO, an initial public offering. And that usually also is a fundraise, but we will definitely cover that at a later point. That's it for this video. Thank you very much for watching Raw Startup. Please like and subscribe.